Good day, everyone. I hope you guys are doing well. Today, I just want us to look at how do you identify control weaknesses in an assessment or in a scenario. And then we're going to look at three types of control weaknesses. Look at how to identify significant risk using those control weaknesses. But one thing before we start, I want us to remind you of something in terms of what exposes organization to risk, because there is what we call risk factors, which is the organizational context that could lead to risk. Now these are sources of risk, and they can be coming from the internal context of the organization or be coming from the external context of the organization. Now, when we say an organizational context, these speak to the operational environment of the organization, the conditions that the organization is faced with, such as the business nature, the form of ownership, the type of business, the type of product that they are selling, or even the processes that are involved in that type of an organization, which is why those processes can have some weaknesses in their system of internal control. Another thing I would like you to note is the difference between control weaknesses and risk, because what I notice as time is that student usually confuses risk with weaknesses or confuses weaknesses with risk. You need to know this when it comes to weaknesses. Weaknesses is the lack of proper internal control in place, and weaknesses can then create opportunities or gaps for a risk to materialize. While on the other side, risk is a possibility of uncertain event that could occur and have an impact on the achievement of an objective. So, what at times you will notice in a scenario, there could be things that are currently wrong or things that are currently taking place within that scenario. And you need to know that those things that are currently wrong, it's not a risk, but rather are weaknesses. Do not confuse risk with weaknesses. Risk is not what is wrong, but what could go wrong. What is currently wrong in a scenario, what is currently wrong in the system of internal control or taking place, or the issues that you are noticing, those are control weaknesses. But a risk is as a result of those weaknesses. If those weaknesses are not closed, they open up an opportunity or a gap for a risk to materialize, which is why here I've stated that a risk is not what is wrong, but what could go wrong. A control weakness is not what could go wrong, that is a risk, but rather what is currently wrong or taking place. What are the issues that you are seeing in that scenario? Because those issues of non-compliance or maybe a control that is not well designed, all those things are weaknesses, are gaps, are opportunities that if they are not closed or getting fixed, then they will open up that gap or opportunity for things to go wrong, which is what we call a risk. Now, another thing that I will want you to note is that control weaknesses can be in three forms. The first form, you can have a control gap. The second one, you can have a control deficiency. And the last one, you can have a control deviation. When we speak about control gap, this is where there is no proper control in place. Remember, we said the definition of control weaknesses, it's a lack of proper internal control. When you have no measures in place to mitigate the possibility of a risk, you have a control gap. There is a gap or an opportunity in the process or the system of internal control for a risk to materialize. But at times you can have an internal control in place, but that internal control, it has what we call control deficiency, which means it's not well designed. There is a weakness in the design of that internal control. And lastly, you can have control deviation, where you have a control in place. This to control is well designed, but it's just not working as intended. Now, the reason it cannot be working as intended, it could be due to non-compliance, where the people who are supposed to be actioning that internal control are not doing what they are supposed to be doing. Because wherever there is human beings, there will be human errors, there will be issues of non-compliance where people are not following the proper way of doing things within that organization. What we're going to do is to look at the practical scenario from an assessment, and then we're going to look at the things or issues that you might be noticing that are currently taking place, and those issues firstly will be weaknesses. And these can be stemming from a control gap, meaning that there is no proper control in place. This can be stemming from control deficiencies where the control is not well designed, or be stemming from a deviation or ineffective internal control where now it's not working as intended due to issues such as non-compliance. Now, before we read through everything, let's firstly go to required. What is required here is that we need to firstly identify at least 5 significant weaknesses in the system of internal control, and then we need to provide 10 potential risks that could materialize if the weaknesses are not addressed. Then the other one of recommending at least 10 internal control which should be put in place to address the weaknesses identified so that the risk will not materialize. And the last one, we're going to look at it in the next video. It is stated that Freshly Pty Ltd is a medium-sized retail company with 50 stores across several provinces. The company purchases a variety of fresh produce from multiple suppliers. The purchasing department is responsible for managing vendor relationship with different vendors, placing orders, and ensuring timely delivery of goods. Recently, the company has noticed a decline in profit margin and increase in inventory discrepancies. The internal audit department has been asked to review the purchasing function to identify potential issues. During the walkthrough, the internal auditor found the following. It was noted that the purchasing manager is the only one responsible for selecting suppliers, and there is no formal process or documented criteria for choosing suppliers. Over the years, the company has repeatedly used the same few suppliers without obtaining competitive quotes. Some of the suppliers have personal ties to the purchasing manager. I want us, before we go further in reading through the statement, to look at this first paragraph. Just looking at this, what do you think are the weaknesses? What are the gaps here? What are the non-compliances? What are the deficiencies in the internal control that in place that you can notice? Even the first statement, it's saying it was noted that the purchasing manager is the only one responsible for selecting suppliers. You can see, just by looking at this statement, you can see there are things that are wrong here. You got one person only responsible for selecting suppliers. You can see that there is no formalized process or documented criteria for selecting suppliers. You can see that they are using few suppliers without obtaining competitive quote. You can also see that the suppliers personal ties with the purchasing manager. Now, this is what I want you to be able to note, that these things or issues that are currently happening, or that you can notice that they are wrong, those are not risk because they are already occurring. These are weaknesses. It's a lack of proper internal controls in place. If these are not closed or are not fixed, then they will open an opportunity or a gap for a risk to materialize. Now, if we then can look at identifying these as weaknesses, because that was what was required. The first weakness that we can identify, maybe it's around the purchasing manager only being responsible for selecting suppliers. What you can then state there is that the purchasing manager is the only one responsible for selecting suppliers. And there is another thing that you notice here is that some of the suppliers have personal tie with the purchasing manager. The weakness that you have there is that the purchasing manager is the only one tasked with or responsible for selecting suppliers, while the purchasing manager is also have personal ties with the suppliers. So that's the weakness that you can identify, meaning that if that is not closed or fixed, there are things that could go wrong within the organization, which is what we're going to look at a later stage. Another thing that you can maybe notice is that there is no formalized process or documented criteria for selecting suppliers. That is a weakness on its own in the system of internal control. That one is that the internal control is not even there. We can't say there is a gap or a deviation or the internal control not working as intended. It's just not there. there are no formal or documented process or criteria for selecting suppliers. That is a weakness. If that is in place, there are things that could go wrong that can open up the organization or open up a gap for a risk to materialize. If we go further, we can also see the statement where it's saying over the years, the company has repeatedly used the same suppliers without obtaining competitive quote. To ensure that we are operating in an effective and efficient way as an organization, we are comparing prices so that we can buy from a supplier that offers the best quality but at the same time offers the best price. We should be obtaining quotes from at least 3 suppliers. But if you notice here, there is a weakness in their system of internal control because we are repeatedly using the same suppliers without comparing prices from other potential suppliers. It means we are not obtaining competitive quote. That on its own is a weakness in the system of internal control. So that's how you identify weaknesses in the system of internal control. The second paragraph is saying purchase orders are generated manually by the purchasing staff without requiring a pre-approval from the purchasing manager. Some staff could generate unlimited purchase orders daily, and the POs are randomly generated without a sequence. So same way as the first paragraph, you can notice there are issues here. There is an issue in the system of internal control. The first issue is that purchase orders are generated manually. That's a weakness on its own, because if we generate purchase orders manually, we are bound to make errors. We are bound to not be able to track purchase orders. So that on its own is opening up a gap for a risk. Another issue here is that the purchasing staff are generating purchase orders without requiring pre-approval from the purchasing manager. That's an issue on its own, because the reason you requiring approval, you want to avoid people from ordering things for personal use or even just making honest human errors. Now, if you have a purchasing manager reviewing the purchase orders and approving that we can make this purchase, then you're going to avoid such issues of ordering for personal use. So as you can see there, that is already a weakness, that we are generating purchase orders without requiring an approval from a senior person. Now let's go further. Another thing that you'll notice is that some staff could generate unlimited purchase orders daily, and POs are randomly generated without a sequence. That is a weakness on its own. How you can then write that weakness is that purchase orders are not in a sequential manner, and purchases employees can generate unlimited number of PO without needing approval. On its own, having people being able to generate unlimited number of purchases daily, and at the same time our purchase orders are generated randomly, there is no sequential manner that has been implemented here. That means if, for example, there is a fraud taking place or there are some errors taking place, those cannot be able to be detected or traced back because there is no sequence and people can just randomly generate purchase orders. So that's how I want you guys to be able to identify weaknesses. Then if you go look at the third paragraph, when goods arrive at the warehouse, they are checked by the receiving clerk, but there is no procedure for cross-checking the received goods against the PO, and no documents are prepared and signed to acknowledge the receipt of goods. The goods are sent to the storage room if the warehouse manager confirmed they were expected as informed by the purchasing manager. Maybe we can look at the last one. The purchasing manager receives monthly report on purchasing activities but does not have time to review them regularly, and stated that I trust the suppliers as they have been used for years and always provide fair prices. Another issue that we're noticing is that there is no procedure for cross-checking goods that we've received against the goods that we've ordered. We can end up, for example, receiving incorrect number of goods or even incorrect quantities, because the purchase order is going to tell us the number of items that we've ordered. Then when we receive those items, we count them in terms of quantity and quality, and then we compare against the purchase order to say this is the number of items that we've ordered and it's also the correct items that we've ordered. that is not taking place. There is no procedure for cross-checking goods that we've received against the goods that we've ordered. Now, another thing that you can notice is that there is also no document which is prepared and signed to acknowledge the receipt of goods. Remember, the role of a receiving clerk is to receive inventory. Now, before you receive inventory, the receiving clerk will need to count the goods in terms of the quantities, check is the correct quality and the product specification that we've ordered, and then they need to prepare a goods receipt note to acknowledge the receipt of those items. But here it's currently not taking place, that the receiving clerk does not prepare the appropriate receiving document, which is the goods receipt note, to acknowledge the receipt of goods. That is another issue or weakness in the system of internal control. Now, if we can look further, it also says the goods are sent to the storage room if the warehouse manager confirmed they were expected as informed by the purchasing manager. That is also a weakness in the system of internal control. That means they only transfer goods by a word of mouth. They don't do the comparison, the three-way match of checking the PO, the delivery note, and then the goods receipt note that they prepare to ensure that this is the correct items and then transfer them to the warehouse. But here they use a word of mouth where the warehouse manager confirms with the purchasing manager that these goods were expected, and then there is no transfer documents that is getting used to transfer those items into the storage area of the warehouse. And then the last paragraph there, you can also see that purchasing activities or monthly report are not reviewed by the purchasing manager. How will we know when there are irregularities that are taking place? How will we be able to detect those irregularities? How will we know that we are within our budget in terms of our purchasing activities spent as an organization? Is if we review the monthly report or the purchasing activities, but that is not taking place. So that is a weakness on its own. Another thing you will also notice here is that the purchasing manager stated that I trust the suppliers as they've been used for years and always provide fair prices. So the weakness is also there is here a high reliance on the same suppliers without regular monitoring. These suppliers, we rely on them heavily because we believe they've been providing fair prices, but we're not reviewing their performance, that they are offering us the best price as compared to others, and also at the same time they are meeting our expectation in terms of the quality of goods that we are receiving from them. So all these things are just weaknesses within the system of internal control. Can see there, that was number one, identify at least 5 significant weaknesses in the system of internal control of Freshleaf Pty Ltd, and we've identified more than 5 of those. Now we also needed to provide 10 potential risks that could materialize if the weaknesses are not addressed by the organization. So what we can then do is to use these weaknesses to be able to identify what could go wrong. And I want you to remember that to write a risk, you use what we call a if-then approach, meaning that as a result of these weaknesses not being closed or fixed, there is a risk of something could go wrong. And we need to, the reason we call it if-then approach, there needs to be the risk event and the consequences of that event. That means for each risk that you identify, you need to be able to state what will be the consequences of such a risk, what will be the results or the end goal of such a risk within the organization. Using the weaknesses that we just identify, we can be able to say what could go wrong within the organization, what could go wrong in their processes. Now, if we take some of these weaknesses that we just identified now, for example, we said there are no formal and documented process or criteria for selecting suppliers. If the organization does not have a formal process to select suppliers, what could go wrong as an organization and what will be the consequences of that? Meaning that you can then start thinking in your mind that as a result of no formal or documented process or criteria for selecting suppliers, there is a risk of favoritism. resulting in a conflict of interest. A formal criteria or process will ensure that we are consistent across different suppliers. We look at your pricing, we look at the quantity of goods that you're going to provide for us. Now, in this case, if we are not following a process, the person who's supposed to be selecting suppliers will favor certain people, will favor friends, will favor business associate. So that means as a result of having no formal or documented process or criteria for selecting a supplier, there is a risk of favoritism resulting in what? In a conflict of interest. That's how you write a risk using a weakness. Now, if we look at next weakness there, we said the purchasing manager is the only one that is responsible for selecting suppliers, and we also noted that they have the personal ties with the suppliers. So as a result of that, suppliers may overcharge the company, resulting in high cost of inventory or resulting in financial loss. There is a lot of consequences that can result from this risk. Another person can say, okay, as a result of the supplier having personal ties with the purchasing manager, there is a risk that there could be favoritism. Or another person might be thinking in an issue of we can overspend, we can be charged higher prices, resulting in a financial loss. So there is so many ways you can be able to write such a risk. Another weakness that we've identified was that the company uses the same suppliers without comparing prices from other potential suppliers. We are selecting the same suppliers. We are not looking at comparing prices. So there is a risk there that we might overspend in a supplier, resulting in a financial loss. Because what if the suppliers that we are using are the most expensive one, but if we're getting 3 quotes from different suppliers, we can be able to get the best price. Now, another thing as a risk is that the supplier may offer inferior product, resulting in missed opportunity for better prices and product quality. If we use the same people, what if they are offering inferior product over and above just offering at a more expensive price? That means we will miss that opportunity there for getting a better price and also a better quality of the product. So that's another risk that we can be able to identify from there. If we go further, we also notice as a weakness is that purchase orders are manually generated without needing an approval there. We don't need an approval. So the risk is that as a result of purchase order being manually generated without needing approval, there is the risk that unauthorized purchase orders can be executed, leading to misappropriation of company fund or fraud. We can end up executing purchase orders or placing orders to the suppliers that were unauthorized, and that will lead to a misappropriation of our funds as an organization or fraud. Or another risk you can come up with using manual POs and not needing approval is that employees or purchasing staff can order goods for personal use, resulting in what? In a financial loss for the organization. So there is so many things that can be as a result of this weakness not being closed within the organization. Another weakness that we've identified was that the purchase orders are not in a sequential manner. And there was also an issue of employees generating unlimited number of POs without needing an approval. So you face with an issue where people can generate purchase orders randomly in an unlimited numbers, but at the same time they don't need approval, and these purchase orders are also not in a sequence manner. There is a risk that the organization may not be able to track or verify purchase orders, resulting in errors or irregularities. Because if there is an error within a purchase order, how will you be able to track if the order numbers or the purchase order numbers are not in a sequence? So that's the exposure that the organization has as a result of that. Now let's look at another weakness. There was also a weakness that there is no procedure for cross-checking goods received against ordered goods. When we're receiving item, the receiving clerk was not checking that this is the correct quantity or quality of goods that we've ordered. So some of the risk there as a result of that is that deliveries may not be recorded as received, resulting in errors in our inventory records. But another risk is that we may receive incorrect quantities or qualities of goods because we are not checking that are these even the goods that we've ordered as an organization. We just accepting item without having a proper procedure for cross-checking or cross-referencing, if we can put it that way. So that's another thing that can take place within the organization. There was also an issue that the receiving clerk does not prepare the appropriate receiving document, which is your goods received notes, to acknowledge the receipt of goods. There's two risks that can stem from this. You can have an issue where a supplier has not delivered an item and they can say they've delivered it, and you will not even notice that it was delivered as an organization because you're not preparing document to acknowledge that I've received an item. But there is also a side where a supplier has delivered the goods, but you have not recorded or updated your record to say they were delivered. So you might accuse the supplier that they did not deliver because you did not prepare a goods received note to acknowledge that really I've received this item and it's the correct quantity or quality. So there is a risk there on both element, and what will going to result in is inventory shortages because you are going to receive incorrect quantities or qualities. Before you even sign that goods received note, you might have checked the quality of the goods and the quantities that is the correct one. So that's the thought process that I want you to have. Another risk that maybe can stem from that is that there is a risk of theft. The receiving employees may or can steal the inventory because there is a lack of proper documentation. How will you don't even know what you've received or not received? So they can see a weakness there or a gap to say, actually, if I decide to steal some items of inventory here, no, there is no one who's going to know that these inventories were received. So that's another issue there. But remember, we also use these goods received notes to record our inventory. We use them as a source document to prove that a transaction has taken place. So there is also a risk of inaccurate inventory record, which can result in increased write-off or errors in financial records. Because if you don't know what you've received, you did not acknowledge it via a goods received note, your inventories will be inaccurate as an organization, and at a later stage the consequence is that there will be a financial loss there. There will also be some write-offs that will need to take place within that organization. Now let's go further. We also said that there was an issue where the purchasing manager is receiving monthly report on purchasing activities, but they are not being reviewed by the purchasing manager, as they said they do not have the time. So as a result of that, there is also a risk of errors, fraud that may not be detected in purchasing activities. You can have an issue where there is fraud that is taking place, or some irregularities that are taking place, or some honest human errors that may or can or could take place but cannot be able to detect them, and the consequences is that we're going to lose money. What if the purchasing clerks are busy ordering things for personal use? As a purchasing manager, you will not know of that if you do not review your monthly report. So that is the issue that you can detect there, or you can identify as a possibility of an event, which is our risk. And there is also one of the weaknesses was that we have a high reliance on the same supplier without regular monitoring. We don't monitor our suppliers as an organization. There was also a statement that I trust the suppliers, whereas we've been using them for years and they provide a fair price. You can also be faced with an issue where there is a collusion between the purchasing manager and the supplier, where they collude to commit fraud, and that will result maybe in inflated prices or receiving inferior product, or even paying more, where they decide, you know what, let's just inflate the price, or I'll offer you inferior product and you pay me more, where they collude and share profit between the purchasing manager and the supplier. And another thing, because we don't review the performance of our suppliers, there is also a risk that the supplier can fail to deliver, resulting in loss of sales or even reputational damages, because there will be a shortage of inventory within the organization as they are failing to deliver on our expectation as an organization. So that's how you can identify risk. You use the weaknesses to say, as the results of this not being fixed or taking place or not being closed, there is a risk that, and you need to also tell us the consequences of such a risk. So that's how you write risk statements. So what I want to emphasize is that please do not confuse weaknesses with risk. Do not identify the things that are currently wrong in a scenario as being risk, because remember, risk is what could go wrong. Those things that are taking place now are weaknesses, and they are currently wrong. So you cannot be forward looking and say they could go wrong while they are already going wrong. So as long as you know that the weaknesses, it's what is currently wrong, and they can take form in three ways: where you have a control gap, there is no proper control that is in place. At times that can be control deficiencies, where it's just a weak system of internal control, and it can also be a control deviation where someone is not doing what they are supposed to be doing. And if you think of this scenario, you had a purchasing manager that is receiving the monthly report, but what they are doing is that they saying they don't have the time to be reviewing that. So that means we have a weakness in the system of internal control. So that's the thought process that you can use in identifying weaknesses within a scenario, and then using those weaknesses to write a risk using the if then approach to write your risk statement. I hope that is making sense and it can help you in preparation for your assessment. Have yourself a great day, and thank you.